The US economy has been surprisingly resilient in 2023, and this is because the COVID-related fiscal handouts are still having an effect, lower household savings and post-pandemic related supply tailwinds are still helping to offset the tighter financial conditions. We believe that the Fed's action will continue to slow the US labor market and economy over the next 6 to 12 months. A US recession in mid-2024 is likely, as the tailwinds will fade. Asia will be weighed down by a slower China, as well as slower export demand from developed economies. But economies with a large domestic consumption will be much more resilient. We expect inflation to gradually decelerate until mid-2024, as long as there are no material commodity price shocks. That said, the Fed is unlikely to be too dovish if inflation remains elevated. Beside the Fed's policy, the credit and fiscal impulse in the US will also significantly affect earnings growth and recession probability in 2024. Sentiment towards China is currently extremely bearish. If the Chinese authorities surprise on the upside, and they've got plenty of room to do so, this could potentially have a very positive impact on consumer confidence in China and investor sentiment towards their risk assets. Valuations of emerging market and Asian equities are more attractive than the US. Japan stands out amongst the developed peers. Cyclical tailwinds and structural reforms continue to favor the market. Current Japanese valuations are attractive rather than being super cheap. Any pullback in that market could be used as a buying opportunity by investors. Very elevated bond yields suggest that there are income and capital appreciation opportunities from high-quality bonds, and the current market pricing of Fed rate cuts appears to be too benign. We expect the US Treasury yield curve to continue to steepen. Supply chain transitions will continue to be driven by geopolitical considerations and the desire for greater resilience in supply chains. This will benefit certain emerging markets, including the ASEAN economies, but it may also drive overall costs higher. Generative AI has profound implications for global productivity, growth, and profitability. So far, investor attention has been focused on semiconductor and direct AI stocks. However, AI tools have the potential to reshape industries such as healthcare, manufacturing, and others. Thinking around sustainable investing is also evolving. While many investors have avoided the hard-to-decarbonize assets, there is a growing realization that valuations have become very attractive for these assets and that active engagement can bring about real change and deliver positive climate impact. The opportunities are particularly abundant in Asia and emerging markets, as brown industries make up a significant percentage of GDP for these economies.